Hi everyone. As you start your month, you start your new year, a brand new year, 2026. Let's talk about profitability. What is profitability? Well, everyone knows that the income you generate from the sales that you make, whether you're selling goods or you're providing a service, that is what we call revenue or turnover or sales. However you want to put it. For some people, they are billing. Some people are calling it fees or commissions earned. It's whatever you want to call it, but it is turnover or it is sales. So for the purposes of what we're doing today, I'm just going to call it turnover. Of course, some people will have what we call a cost of sales. Not every business has that. A cost of sale are the costs directly linked to the production of income. So for instance, if you're manufacturing shoes, then your cost of sales would be your raw material, which is buying the actual leather, and some of the costs involved in producing the actual shoe. It can also include the wages for the factory staff. The factory costs can include transport. Maybe you're importing some of your goods or you're importing some products. That would all be cost of sales. And then, of course, you would then have your expenses, which is your overheads. And those can be administrative costs. Those can be your salaries for your management staff. That can be your advertising, your computer expenses, your telephone, all those expenses that you incur in order to arrive at your profit or loss. So profitability is a term we use to describe your turnover, which would be high, and then you deduct your cost of sales to get your gross profit, and then you deduct your total expenses to get your net profit or net loss. And a profit would then be a positive figure. In other words, you are remaining with a positive profit after you have deducted all expenses. Remember, however, there's the issue of stock and inventory and having to account for it so that whatever you buy and you're keeping, you do not shoot yourself in the foot by including your stocks as a cost. You need to deduct your stocks. You need to be able to say, okay, from the 5,000 US dollars, 200,000 Rand, 1 million Rand worth of stock that I purchased, I have only utilized X amount, therefore I should be deducting my stock in order to arrive at the actual cost. Because remember, you need to match your sales in that period with the cost that you have incurred in order to make that sale. So it should all be related to the next period. Your inventory will be used as cost of sale maybe in the next period or the next 2-3 periods. So it shouldn't then be used to calculate your profit in the period concerned. I hope that makes sense. So when we say profitability, what's your profitability? We're looking at ratios. We're looking at perhaps your gross profit as a percentage of sales, your net profit as a percentage of sales, your net profit as a percentage of, we said sales is turnover. So you can also look at your net profit as a percentage of your overheads. All of those are profitability ratios that one can use to determine how well you're doing. You can compare your current profitability with the prior month. You can also compare it with your budget in the same month. You can also compare it with your performance in the same period prior year. That's why it's important to have all your management accounts and to be able to tell how well you did same month last year, or how well you did last month, or how well you had forecasted in your budget and intended to perform. That way you can rate yourself and see where you're going and be able to take corrective measures if necessary, or pat yourself on the back if you've exceeded budget, if your profits are higher than you've expected. You also need to be careful. There could be errors in calculation. If your profits are suddenly higher than you had anticipated, perhaps you have a gremlin in the formula. Hopefully not. Join me as I discuss these and many other topics in our